A move by China has the potential to upset the balance of power in the world. Under its guidance, over 20 nations convened in Kuala Lumpur. This is neither a routine meeting nor a protocol formality. It concerns a bloc that creates a single, potent orbit that includes China, the Gulf states, and Southeast Asia. Together, they represent nearly 2 billion people and over $25 trillion in economic power. BRICS were thought to be the primary threat to Western dominance for many years. However, what is now coming to light goes far farther. This alliance has actual influence over trade, energy, and investment that impact every nation on the earth, since it controls more than half of global economic development. China is literally and figuratively building bridges while Washington is mired in a never-ending battle over politics and tariffs. From enormous oil and gas transactions in the Gulf states to high-speed rail projects in Indonesia, what is being constructed is a cohesive economic system rather than merely a gathering club. No is the question. Longer if this change would be significant. It does already. How far it will go and what it signifies for the future of American dominance are the real questions. History may have come to a real crossroads in Kuala Lumpur. China united the Gulf Cooperation Council, the ACON states, and itself on a common platform, bringing more than 20 nations to the table. Although this may appear to be just another regional conference, it is actually the start of something far bigger, an economic bloc that has the power to move the center of influence throughout the world. The numbers are self-evident. Together, these nations employ over 2 billion people and produce a GDP of over $25 trillion. Furthermore, this is a current reality rather than a strategy for the future. Together, they account for over 55% of global economic expansion, making them the primary forces behind global economic growth. When such a group starts coordinating energy, technology, and trade, it generates momentum that even established nations must deal with. BRICS were formerly thought to be an alternative to the West, as many people recall. However, it now appears tiny in comparison to this combination. BRICS were slowed down by internal inconsistencies. While the new bloc is being constructed around common interests, the players are already connected via trade routes, energy flows, and investment corridors. This is not a platform for speeches. Rather, it is the framework for a parallel system that would allow infrastructure, settlement currencies, and supply chains to operate independently of Washington and Brussels. This summit was important for that reason. It was about a signal, not grandiose declarations. The events that followed only served to highlight how rapidly U.S. dominance is eroding, and the global South is prepared to act as a unified force. Washington was busy with its own issues as the new alliance was being formed. On paper, America still has the biggest economy, but its influence over international trade regulations is clearly waning. Formerly reliant on trade with the United States, allies are now looking for alternative avenues. Mercosur's relationship with the European Union in South America has improved. Vietnam has inked contracts to diversify exports with the EU and Canada. Even longtime security allies South Korea and Japan are growing their Asian connections. Each of these actions progressively erodes Washington's pivotal position in the world economy. It's an obvious message. Partners are forced to look for alternatives as a result of tariffs, and the majority of those options go straight to Beijing. America is rapidly filling the void left by its inward orientation. In Southeast Asia, where trade flows are particularly prevalent, already changing course. The most obvious example of how the global balance is shifting today is Southeast Asia. Trade with the United States was a major source of income for nations like Vietnam, Malaysia, and Indonesia for many years. However, many of those relationships started to fall apart following successive rounds of tariffs. And Beijing provided them with a substitute. Consider Indonesia. When Washington levied 10% taxes on a variety of items in April, Jakarta's trade, the surplus, fell apart. It dropped to $160 million by May, the lowest amount in 5 years. Concurrently, there was a greater than 20% increase in the importation of machinery and equipment from China and Singapore. The narrative is straightforward. Indonesia searches for other avenues after the U.S. market closes, and Beijing is the first place that opens up. Trump's decision to increase steel and aluminum tariffs to 50% dealt Vietnam a similar blow. Vietnamese steel exports to the U.S. decreased, in the start of 2025, by 27%. This was a jolt to an export-based economy. Hanoi persisted, though. It improved relations with regional allies and China. The tendency is supported by the data. In 2024, trade between Asia and China was $982 billion, or about 20% of all trade in Asia. Early 2025 data indicates continued increase. The Asian-China Free Trade Agreement's most recent iteration prioritizes the sectors of the future: smart manufacturing, renewable energy, and digital services. Furthermore, this goes beyond simple paper signatures. Concrete projects demonstrate the changes. Manufacturers benefit from faster delivery times because to the Asian Express transport route that connects Malaysia and Chongqing. Since its opening at the end of 2023, Indonesia's $7 billion high-speed train route between Jakarta and Bandung, which is a component of the Belt and Road Initiative, has already transported over 9 million passengers. These are blatant instances of how China is drawing the area closer to its orbit. ASEAN is no longer a group of minor players in the middle of a new trade map that is emerging. It is developing into a factory in China, a center for investment, and a point of entry into international supply networks. Furthermore, this change merely prepares the way for a more significant change in the infrastructure and energy of the area. Trade stats are not the only thing that has changed. They can be seen in the energy flows and networks that economies rely on. And this is where China makes its mark, changing the system's norms. With Chinese assistance, Kuantan Port in Malaysia doubled its capacity, becoming the biggest transshipment hub for industrial commodities and iron ore. Similar expenditures are being made in Indonesia, where new cargo facilities are being constructed to accommodate the increasing volume of containers. There's more to these ports than infrastructure. They serve as entry points that reroute supply chains away from Western-controlled routes and toward Asia. They are providing Southeast Asia with options that were non-existent a decade ago and firmly securing the area in China's orbit. The same pattern is seen in energy. Oil prices in dollars gave Washington tremendous clout for decades. The hold is loosening today. Currently, about 30% of Saudi oil shipments are made in currencies other than the US dollar, and recent agreements indicate that percentage may rise. The first liquid natural gas experiment was conducted in 2023 by the French and Chinese corporation Total Energies. Gas transaction, an indication that even businesses in the West are aware of the direction the future is headed. Then there are renewable resources. Approximately 80% of the world's solar panels are made in China. It dominates the supply chains for batteries and is the top exporter of wind turbines. Therefore, it makes no difference if the world uses solar energy or oil in the future. The focal point will be Beijing. These actions alter energy completely rather than only diversifying it. Additionally, the Gulf states are starting to follow Asia's lead as it creates new networks. Today, the Gulf nations are doing things that seemed unthinkable 10 years ago. The Gulf Cooperation Council was closely tied to Washington on energy and security issues for many years. However, such connections are eroding now as a conscious shift toward Asia takes their place. The numbers are self-evident. Trade between ASEAN and the Gulf states reached over 130 million in 2023 billion. The target is to increase this amount to around 80 billion by 2032. It's not just about oil either. The Gulf states seek to establish enduring alliances across a wide range of industries. In industries where China and Southeast Asia already dominate, such as artificial intelligence, digital banking, and renewable energy, investors from the region are investing. The change is also evident in politics. PO, the president of Indonesia, publicly supported China's request during the Kuala Lumpur summit, expressed support for Palestine and opposition to outside dominance. The leaders of the Gulf states responded favorably to this signal, which demonstrated that Arab and Asian voices